On a day called Liberation Day, quite ironically, US President Donald Trump made a bold move. He announced a massive 34% tariff on everything the US imports from China. And that wasn't the first time. Just weeks earlier, he had already slapped a 20% tariff on Chinese goods. It was a strong signal, but things didn't stop there. China fired back, threatening to put its own 34% tariff on American imports. Trump's reaction? He raised the pressure again, this time adding another 50% tariff on top of what was already in place. At first, people thought this might just be political posturing. But then, on April 9th, Trump shocked everyone by pushing the total tariff on Chinese imports up to 104%. Yes, you heard that right. American companies were now being charged more in tariffs than the actual price of the Chinese products they were trying to import. So if a company was buying something for $100, they'd now have to pay $104 just in tariffs, making the total cost $204. For businesses, this was a nightmare. China's ruling Communist Party made it clear they wouldn't back down. But it was also becoming obvious that matching Trump's tariffs wasn't going to change his position. So what else could China do? That brings us to what some call China's nuclear option in this trade war between the world's two biggest economies, selling off its US government bonds, a financial weapon that could shake up the global economy. But before we get into how that could work, we need to understand why this trade war is even happening, and why the US and China are so deeply connected economically. Let's take a step back. The United States buys way more from China than it sells to China. That's called a trade deficit. In fact, the US runs the largest trade deficit in the world, while China runs the biggest trade surplus, meaning it sells a lot more to other countries than it buys. This has become a major feature of global trade today. China exports massive amounts of goods all over the world, and a huge portion of it, over $500 billion in 2022, goes to the United States. In that same year, the US only exported about $154 billion worth of goods to China. That's a $382.9 billion trade gap, the biggest with any country. But here's the big question. How can this gap keep going on for so long? Shouldn't it balance out at some point? Normally, trade imbalances fix themselves. If a country imports more than it exports, its currency usually becomes weaker. That makes its exports cheaper and imports more expensive, which helps bring things back into balance. Let's look at a simple example. Take Argentina. When it imports goods from other countries, it has to buy foreign currencies by selling its own currency, the Argentine peso. When it exports, other countries buy pesos to pay Argentina. If imports and exports are balanced, the peso stays stable. But if Argentina imports way more than it exports, more pesos get sold than bought. That pushes the value of the peso down. A weaker peso means Argentine exports become cheaper for other countries, and imports become pricier, naturally helping to fix the imbalance. So again, the question is, why doesn't this same logic apply to the US? Why does the US keep running this huge trade deficit year after year without any major currency adjustment? Let's go back to the basics. When China sells goods to the United States, it earns US dollars. Under normal conditions, getting lots of dollars would push up the value of China's currency, the yuan. That's because foreign buyers need to exchange dollars for yuan to buy Chinese goods. A stronger yuan would then make Chinese exports more expensive, which could reduce China's trade surplus. But here's the thing. China doesn't want a strong yuan. A weaker currency makes Chinese products cheaper in other countries, helping China stay competitive in global trade. So instead of letting the yuan naturally rise in value, China's central bank steps in to control it. It prints more of its own currency, yuan, and uses that to buy up US dollars on the international market. This increases the demand for dollars, helping the dollar stay strong and keeping the yuan weak. This strategy keeps Chinese exports affordable around the world. But now China ends up holding a huge amount of US dollars. So what does it do with all those dollars? It lends them back to the US government by buying something called US Treasury bonds, which are basically IOUs issued by the US government. Right now, China owns around $800 billion worth of these US Treasury bonds. That makes it the second biggest foreign lender to the US, after Japan. Back in the early 2010s, China held as much as $1.3 trillion. That's more than the GDP of many countries. But this number might not even show the full picture. In recent years, Chinese leaders, especially nationalists who dislike the idea of funding America, have moved some of these US debt holdings out of the official government books. Instead, they put them under the names of state-owned banks, investment firms, or overseas shell companies. So the actual amount of US debt owned by China could be much higher than $800 billion. On top of that, China has also started investing in other types of US debt, like mortgage-backed securities, basically bundles of home loans sold by companies like Fannie Mae and Freddie Mac, which are backed by the US government. These aren't technically Treasury bonds, but they're still considered very safe. So the question is, why is China lending hundreds of billions of dollars to its biggest economic rival? The answer is simple. US Treasuries are the safest and most trusted place to park money in the world. They're what economists call the world's reserve asset. They're easy to buy and sell, always in demand, and backed by the full power of the US government. Even during a global crisis, investors trust US Treasuries to hold their value. That makes them a very smart, low-risk investment, even for a country like China. But there's a bigger reason why China buys so much American debt. It's part of a long-term strategy. By purchasing US Treasury bonds, China helps keep the American dollar strong. A strong dollar makes it easier for the US government to borrow and spend money. And it also means that American consumers can keep buying more, especially from abroad. And a lot of those purchases come from China. So in a way, China is helping America keep up its spending, and America is helping China keep its factories running. It's a cycle that benefits both countries, and this deep economic relationship has even earned a nickname, Chinmerica. But now that Trump is going after China's dependence on American consumers, people are starting to wonder, could China strike back by targeting America's dependence on Chinese money? The idea sounds dramatic. What if China sold off a big chunk of the US government bonds it owns and caused chaos in American financial markets? Could that actually happen? It's unlikely, and here's why. If China suddenly dumped all those dollar-denominated assets, the value of the Chinese currency, the yuan, would shoot up. That would make Chinese goods more expensive in the global market, and fewer people would want to buy them. Since China relies heavily on exports, this would be a huge problem for its economy. And even if China wanted to sell, it would have to ask, where would all that money go? US Treasury bonds are popular not just because they're from a big economy, but because they're safe, easy to sell, and large enough to handle massive investments. There really isn't another place in the world where China could move hundreds of billions of dollars without taking on much more risk. But the most serious problem is what this kind of move could do to the global economy. China doesn't own most of America's debt, but it owns enough that a sudden sell-off could rattle investors and create panic. That could push US borrowing costs way up, drive interest rates higher, and trigger a massive sell-off in the bond market. And with the US already facing record-high borrowing and rising interest rates, this could push things into dangerous territory, even toward a debt crisis. If that happened, the effects wouldn't just hit the United States. They'd hit global markets too, including China. That's why, back in 2008 during the financial crisis, when Russia suggested that China should dump American mortgage-backed securities to worsen the US crash, China said no. Even then, Chinese officials understood that bringing America down too hard would hurt everyone, including themselves. But that was then. Today, the trade war is growing more intense. If Trump keeps raising tariffs and squeezing China's economy, Beijing might start thinking differently. And if a global financial meltdown starts to feel unavoidable, China might choose to act first, to decide when it happens and how hard it hits.